$100, I don't think it's out of the question. Back in 1979, I think silver was at $16 in November, and by even end of November, and by January 1980, it got up to 50. So it like tripled. So we could very easily double. And if we double, we're at 100.
Coming after the LBMA's liquidity strains in physical metal and amid rising prominence of the Shanghai exchanges, SGE parallels LBMA. Shanghai Futures Exchange, SHFE, parallels COMEX, which is now a subdivision of Globex. The outage feeds a narrative that the Western pricing structure is looking increasingly fragile while the Eastern infrastructure is expanding. In that sense, this may be more than just a cooling system failure.
Physical silver is entering a phase in which structural shortages, historical breakout patterns, and escalating global demand are aligning in a way not seen for decades. As spot prices push into new territory and Western paper markets struggle to maintain liquidity, the momentum now favors physical accumulation and long-term repricing. The combination of rising sovereign purchases, tightening supplies, expanding industrial demand, and renewed monetary interest has created conditions in which multi-dollar daily moves could become the norm rather than the exception. With silver already trading above prior ceilings and the gold-silver ratio breaking down, the setup supports a move toward $70 to $100 in the near term, with conditions in place that could pull prices far beyond triple digits if physical stress deepens. Marioinnecco, a well-known macro voice, and Vince Lanci, recognized for his research on market flow dynamics, note that central banks in the Middle East, Asia, and emerging markets are now accumulating silver alongside gold. This shift historically precedes major phase transitions. With Eastern exchanges increasingly setting the real price, Western markets facing outages, and physical premiums rising, the next breakout could be both violent and sustained. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Basically, physical demand for silver is overwhelming the paper market. And 3.5 years ago, a little more, we had the silver squeeze movement. And that didn't really go anywhere. We got to 30, and then there was a lid there, mainly because the big sovereign buyers of physical silver that we're seeing now, and also big investors, they weren't interested in silver. They might have been buying ETFs, but they weren't interested in physical. But now everything's changed. And I think that's why silver is picking up. And also silver has still to catch up with gold, because don't forget, gold in 1980 got to just below 900. And now we are here at, I think, 4,200 as we speak. And silver got to like around 50 in 1980, and it's just moving above 50 now. So I think, since mid-October, there's been a correction, and a lot of people weren't too sure if silver was going to make it back up. But I think this is very significant that we made it back up, and we've made a new high. Yeah, gold is lagging, but I'm not concerned about that. I think if you look at the gold-silver ratio, it's breaking down, which is a good thing. Back in the 70s and also in 2011, towards the end of the bull market, silver really caught up and went higher. And I'm not saying the bull market is near an end. Precious metals, I think, is far from over. But usually it's good to see silver leading the way. The most important aspect is that actually central banks, like in the Middle East, like the Gulf Cooperation central banks, even Turkey, Russia, China, they're all starting to buy physical silver. And I've even heard that Dubai now, they want to they're creating a tokenized silver instrument. Basically, they want to make silver kind of money again, which is quite amazing. I don't know if you saw the other day, Dubai, they showed this silver bar. It was 1,971 kilos, so almost two tons. And yeah, they're really into silver. We saw that India is going to allow individuals and companies to use silver as collateral for money, for loans, excuse me. So yeah, up until 6 months ago, the reason people gave for silver underperforming gold was that, well, central banks only buy gold, they never buy silver, but that's completely changing, and I think that's huge. And I think the silver price, right now we are like in what one would call terra incognita, like we're in territory we don't know. It's never been there before. But yeah, I think there's such huge potential for silver now that central banks are getting involved. And unfortunately, in the West, very few people are aware of this stuff. I mean, you and I are aware because we listen to you listen to me, I listen to other people in the gold and silver space. But the mainstream is like completely like not really aware of it yet. Maybe the fact that like Tucker Carlson has started his own precious metals dealer might help wake people up a little bit. He's got a big following. So yeah, that's the major thing. These countries outside the West, yeah, they're going back to silver. Even Korea, South Korea, the central bank there has started buying gold again, but also silver. So, and we also seen, Elijah, that the United States and China, they've put silver on their critical minerals list. So everyone wants to get silver before those two giants get a lot more. Yeah, I mean, I remember back in from 05 to 08, even though I was a futures and options broker for government bonds, we had a client that traded a lot of silver. And so I was involved in that. And I could remember $5 days when silver was between $15 and $20. So I don't see why we shouldn't see $5 days again, especially now that we are above 50. And I mean, as we speak here, we're just trading at 56, the spot price. That's a new all-time high. And we're actually up, Elijah, $2.60, which is half of, I guess, 5. But yeah, $100, I don't think is out of the question. Back in 1979, I think silver was at $16 in November, and by even end of November, and by January 1980, it got up to 50. So it like tripled. So we could very easily double, and if we double, we're at 100. That's why I said that in my video from yesterday. CME exchange is probably the biggest exchange in the world, derivatives exchange. For them not to have backups and continue trading is kind of far-fetched, especially during this Thanksgiving weekend where the markets are a lot quieter. There isn't that much activity. We've seen a lot busier days where everything runs smoothly, especially back in October when silver was down massively. They didn't close anything down. Yeah, they're going to say, oh, it was a technical glitch. But yeah, physical, I always say you start with physical. That's how I started back in 03, buying physical silver. I had started buying gold a year earlier. Avoid futures, avoid ETFs. The reason I say that is because ETFs are just a promise. They say they've got silver backing it, but I don't trust the banks. You've seen what happened today on the CME/COMEX. They just closed it. They could do the same thing with the ETFs. They could decide not to deliver to you, or even big institutions. And then there's the mining stocks. If you want to get involved and get more leverage to the silver price, I don't see why not. It just depends on the individual. And yeah, because sometimes I guess if you don't have enough room, it's quite bulky to get physical silver. So it could be easier to own some silver producers. That's the other alternative, I would say. And again, not financial advice, like you said, just our opinion. I think we could see next week silver be very explosive to the upside. We could see a lot of volatility as well. And I expect the premiums to go higher for silver because the dealers, when it's very volatile, they need to have a wider bid and offer spread to protect their profitability. So that's the only thing I would say right now.
The outage hit at the worst possible moment, right as precious metals were displaying exceptional strength and futures markets were driving momentum to new highs. With silver at record levels and platinum breaking out alongside the launch of China's new futures contract, liquidity was flowing aggressively into the metals complex. Spot markets continued trading, but without the usual offsetting flow, prices briefly dropped into isolated, order imbalance territory. This event highlighted a deeper structural reality. The metals ecosystem now operates on a fragile bridge between centralized Western venues and rapidly growing Eastern platforms. A single break in that link showed how quickly global pricing can fragment, reinforcing the broader shift away from unified markets toward regionalized, competing centers of influence. Let's get back to the interview.
At the moment the outage began, precious metals were exceptionally strong. Silver was at all-time highs. Platinum was surging. And on that same day, China launched its new platinum futures contract, which opened strongly and drew considerable attention, as new contracts are wont to do. Then, once Globex went offline, silver sharply reversed in the spot market, giving back much of its earlier gains. To traders watching closely, it looked as if the physical market price struggled once its futures contract vanished, exposing how interdependent the two markets have become. One veteran trader put it bluntly, perhaps too bluntly, when he suggested that, quote, someone pulling the plug on the COMEX until they could get that paper book that they have in order, referring, I think, to the rehypothecation cross orders. That's speculation, and it should be treated as such, but it captures a sentiment that arises whenever a key pricing venue fails during critical market moments. Robinhood, for example. Okay, smaller exchanges in crypto that shut down when the market gets too strong or too weak. History has its own analogs, such as the London gold pool in the late 1960s, when coordinated efforts were used to steady a market under stress. Cannot emphasize enough that if people are talking this way, then trust is being eroded in the institution that directs that has such an important part in our system. Whatever the underlying cause, the optics are not good for CME. They are not good for Western market leadership more broadly. Coming after the LBMA's liquidity strains in physical metal and amid rising prominence of the Shanghai exchanges, SGE parallels LBMA. Shanghai Futures Exchange, SHFE, parallels COMEX, which is now a subdivision of Globex. The outage feeds a narrative that the Western pricing structure is looking increasingly fragile while the Eastern infrastructure is expanding. In that sense, this may be more than just a cooling system failure. It's another sign of a world moving from globalization toward regional realignment, and a world where price discovery is no longer defined by a single center, but by competing ones. Mercantile, if you will. There is one final observation from last night that we would like to draw your attention to, having studied the tape closely. And let's bring up a chart to that effect first. Here's a couple charts for you we'll go through. There's the Reuters coverage of the story. There is, I forget the name of this organization, but they do a lot of data coverage. That's the cooling issue at data center halts futures trading for CME Group. There is the data center. I'm not sure if that's a real rendering or AI generated. Here's the Financial Times coverage. Bloomberg's is behind a paywall. There's a picture of the CME. And now we go to the charts that spurred this last opinion. And this is what I believe is going on. It reveals the problems that were described, but I think it aptly describes what happened mechanically in a forensic point of view. Okay. This reflects the market structure rather than any theory about intent. When the CME futures complex went offline, but spot metals continued the trading, the price action exposed the degree of interdependency between the two venues and the interdependency in metals of the bullion market, the bullion dealers, to trade both venues. So on the left-hand side, you see silver futures. Silver futures. On the right-hand side, you see a representation of spot, not the true spot market, but CFDs, which trade out of Europe. The left-hand side, when the futures closed, they closed. The right-hand side, the silver market, had a very deep dive immediately thereafter. And then it reorganized itself, and it seems to be normalizing. But the deep dive after the gray line is what I'm talking about here. It'll be more obvious in gold, but I want to leave silver up here for the moment. If you review the charts from this window, you will notice a pronounced dip in gold during the outage. This is silver. Let's go to gold since I'm talking about it because it's worse. All right. The simple interpretation is structural. A meaningful share of the incremental buying in precious metals originates from the future side, while a meaningful share of incremental selling flows through the spot and OTC market. When the futures market suddenly disappeared, the buying flow that normally meets OTC selling, where the bullion banks play, suddenly disappeared. Okay? The selling still arrived because the OTC market has its own origin order flow, but the buying was not present. So the selling, again, still arrived, but because the OTC market was open, the buying that normally offsets it was unavailable. With no counterparty to absorb the flow across exchanges, prices moved lower. This is not a conspiratorial argument. It is an illustration of how the ecosystem actually works. People familiar with this program and with this newsletter know that we talk about EFPs a lot. The EFP is an example of this. The futures market is where a large portion of the speculative and directional flows originate. The spot and OTC markets reflect physical related, commercial, and arbitrage activity. Banks and major liquidity providers operate across both venues and use each market to hedge or offset flows from the other. Now, when one venue goes dark, the intermediaries who knit these markets together cannot perform their normal function. Last night demonstrated this clearly. Without the futures side operating, the OTC side became temporarily order imbalanced. The intermediaries who usually bridge the spread between both markets were unable to do so because one leg of the bridge was offline. The result was a short window where spot prices traded in isolation, a real-time example of market fragmentation. And a lot of the selling got bad fills. This is an important lesson about the structure of the modern metals market. It is globally connected when everything is functioning, but that connectivity is now fragile. A single failure at the electronic exchange level can cause the global pricing mechanism to split into separate islands. The fragmentation, even if temporary, is a form of deglobalization in practice, a sign of how reliant the system has become on centralized price discovery and how quickly it can fracture when that center experiences stress. This should be taken seriously. It was a rare event, but it exposed one of the most important truths about today's metals markets. The system works only when all the components work together. And they will not work together anymore in this geopolitical environment. So, spoofing aside or shutting down a market to get things organized aside, very dangerous stuff to happen. And extremely, I can't tell you how rare this is. All right. The CME built something called the Aurora Center for co-location. I mean, redundancy upon redundancy. This shouldn't happen. There are 3 or 4 fail-safes before it goes out. So holidays may have had something to do with it. But regardless, You can see what it did to gold. You may not be able to see it here, but because of the rendering, but I'll show you what we're talking about here. Gold, these are 15-minute charts. An hour after, dipped all the way down to here, rebounced, and then retested it. So gold was the most aggressive example of selling that could not find buying. Silver, while it wasn't the most aggressive net, was the most aggressive in the 45 minutes afterwards. So somebody got a bad fill on their selling, or maybe somebody panicked and had to sell and the exchange was closed, so they went to the OTC market. Anyway,
the events surrounding the metals outage underscored how quickly confidence can shift when the market's underlying structure is tested. Precious metals were pushing into decisive breakout territory, and the sudden disconnect revealed the limits of Western pricing systems at a time when global liquidity is already fragmenting. With the East expanding its capacity, the balance of price discovery is no longer anchored to a single center, and episodes like this accelerate the transition. As physical demand strengthens and more participants highlight the fragility of paper-driven benchmarks, the move toward alternative venues becomes less theoretical and more visible in real time. These developments reinforce the long-term trend of capital moving toward tangible assets, regional alignment, and diversified settlement pathways as systemic trust continues to weaken. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.